Hi, I'm Susan Kriegel, and welcome to The Real Estate Investor. Today, we will talk about the top 5 key factors when investing in real estate. Number 1, location, location, location. While it may seem obvious, the old saying is true, and many people underestimate the power of well-located real estate. During the run-up to the 2008 recession, many financial institutions invested in places where demand didn't yet exist, like the remote suburbs of Southern California. When the housing boom stopped and the bubble burst, the real estate itself had very little inherent value due to its location. One advantage of investing in local real estate is that you know the property's location and understand what is going on in the surrounding area. Additionally, the internet has given rise to fabulous information on how to invest. A simple way to think about it is, regardless of the condition of the market, is this a location that I would want to own 10 years from now? Developer track record, number 2. After location, the quality of the developer and their track record is our most important measure. An ethical, competent developer is critical to the success of any real estate development. Like with any company, an experienced entrepreneur has the ability to manage the inevitable ups and downs and can make all the difference between failure and success. Number 3 is price. Like Warren Buffett's motto when it comes to stock investments, we believe the most reliable real estate investment strategy is to focus on value. Buying value means purchasing properties at or below their replacement cost. If it costs $350 per square foot to build a new building and you can buy an existing building for $250 per square foot, then you have made a value investment. Real estate is a hard commodity, which means that there is a limited supply. Unless we start building new islands, ultimately there is a finite amount of land in the world. So if you can buy a property today at a good value price, i.e. less than what it costs someone else to build the same thing, then over the long term, at some point, the price will rise. Number 4, the quality of the building. As it happens, another component of Warren Buffett's investment strategy is to purchase quality assets, like a good location. A quality building that is well designed and constructed pays dividends, especially over the long run. High-quality buildings not only require less ongoing maintenance and capital repairs, but they also tend to lease faster and at higher rents. The best quality buildings are unique, LEED certified, and create a sense of place, which in turn can bring crowds. Crowds equal demand, which in real estate is almost always a good thing. And last but not least, number 5 is leverage. The amount of the debt on your property will magnify both your investment returns and risk. To give you a sense of just how powerful leverage is in real estate, let's look at an example of a real estate deal under normal conditions. Typically, a real estate deal will have approximately 65% debt, i.e. for every dollar of equity you put in, the lender will give you roughly $2 in debt. Imagine now that the real estate industry starts to boom and bankers begin to compete to give out real estate loans. If the lender gets aggressive and decides to increase the amount of your debt, your equity can buy a lot more real estate. For example, 75% debt, lender gives you $3 for every dollar you put in. 80% debt, lender gives you $4 for every dollar you put in. And 90% debt, the lender gives you $9 for every $1 you put in. As you increase your leverage and total debt amount, you increase the amount of property you can purchase and therefore potentially profit from. But increased leverage also exposes you to much greater risk. In the last example, if you are 90% levered, a minor 10% swing in the property value or annual income can wipe out your entire investment. We believe that a healthy amount of debt is somewhere between 60 and 75%. And here is the conclusion. These are just a few of the basic considerations to look for when evaluating real estate investments. There is more to investing than meets the eye. We did not even mention tenancy, market competition, debt, terms, inflation, transportation, and other public infrastructure, operating agreement terms and fees, market growth and risks, among many other factors to be considered. That is why it is always best to hire experts in the respective fields to assure a smooth transaction and ultimately a solid investment.